Hi, this is Sam, Gallertown School financial analyst. Here's the broadcast of the crude oil and other commodities. I'll be here to share the information with you every week. Oil price eased on August 14th after 7 straight weeks of the gains, supported by the tightening supply on OPEC output cuts. As concerns about China's faltering economic recovery and stronger dollar raised, Brent futures fell 29 cents to 86.52 a barrel, while the U.S. West Texas Intermediate was at 86.95 a barrel, down 24 cents. Price slipped as the U.S. dollar index extended gains on August 14th after a slightly bigger increase in U.S. producer price in July lifted the Treasury yield, despite expectations that the Federal Reserve is at the end of the hiking rate. Oil price may be range-bound this week, as China's sluggish economic recovery and stronger U.S. dollar could depressing, but OPEC will do whatever it takes to keep the supply tight and stabilizing the market. Supply cuts by the Saudi Arabia and Russia, part of the alliance between the organizations of the petrol exporting countries and the other allies, are expecting to erode oil inventories in the rest of this year, potentially driving the oil price even getting higher and higher. The international agency said in this monthly report on August 12th. Reflecting the tightening supply, the price spread between the first and the second months. Brent held steady on August 14th after settling the $84 on Friday, the widest since this March. Russian warship fired another warning shot at a cargo ship in the Black Sea on August 15th, reaching up the tensions in the key areas for the commodities and exports for the Ukrainian and Russia. So, escalating the tension between the Russia and the Ukraine has raised the prospect of disruption to trade in the Black Sea. As for the global situation, the U.S. refined oil gas is destocking. The surge for the European natural gas, driving the European diesel price, with monthly spread and the cracking trend stronger than market. Supported by the upward trend for oil price on the demand side, the geopolitical situation is still heating up, exhibiting the concerns about supply shortage. And in the near future, we are basically facing the oil price fluctuation. The U.S. CPI data will provide further guidance on the Federal Reserve's monetary policy, focusing on the macroeconomic sentiment disturbance. In the short term, there is a significant pressure in the marginal transaction or the intensive areas, and it is expected the volatility will be weak. So as for the PTA, PP, or the other PVCs, the game between the supply and demand and the cost intensifies. The PTA is mainly weak in the short term. In terms of the spot price, the price is strong, and the chemical product had a rebound overall. PTA spot selling tensions remain still high, and spot basis continue to diverge. The intraday basis is basically stable, and the price have increased slightly. On August 9th, the price for the PTA falling and increasing by 32, and the average basis for the spot price stabilizing by 23.09. In August, there were transactions and negotiations around 10 to 20 liters for delivery at the main port. However, there is a strong expectations of supply increment in the later stage, and there is expectations of the shrinkage on the demand side, making it difficult to improve the expectations of supply and demand accumulations. Expect a weak trend of the PTA and the PVCs. So our market strategy is like this. Based on the situation, the international energy market will remain the steady oscillator trend. As for the professional manufacturers, you can consider selling the stocks and inventories under the current situation. As for the import and export trade enterprise, our strategy is conducting the market hedging. So does such a massive change have any impact on your industry? If you have any questions, ideas, or other financial market, please feel free to contact us. I'm Sam, a financial analyst with a passion of quantum physics. Don't forget to follow me. Thank you.